Let's work exercise 15.6 out of chapter 15 related to conversion of bonds. So as always, we'll read the problem, take some notes, and then we'll dive into the requirements of the question. Exercise 15.6. On January 1st, 2025, Gottlieb Corporation issued $4 million of 10-year, 8% convertible debentures at 102. Interest is to be paid semi-annually on June 30th and December 31st. Each $1,000 debenture can be converted into 8 shares of Gottlieb Corporation $100 par value common stock after December 31st, 2026. So the next day, on January 1st, 2027, $400,000 of debentures are converted into common stock, which is then selling at $110. An additional $400,000 of debentures are converted on March 31st, 2027, so a few months later. The market price of the stock is then risen to $115 per share. Accrued interest at March 31st will be paid on the next interest date. The bond premium is amortized on a straight line basis. Okay, so let's take some notes before we look at the requirements. All right, so the first one we have the bonds, debenture. So a bond is a debenture. So we'll use those terms interchangeably. They're dated 1/1/2025. They issued $4 million of bonds. Let's see, the term is 10 years. The interest rate is 8%, and they were issued at 102. So we know that that's going to carry a premium, a 2% premium, since they were issued at 102. Interest is paid on June 30th and December 31st. And they're telling us that they're $1,000 a piece. So if they're $1,000 a piece, let's see if we can figure out how many bonds there are. So there's $4 million worth of bonds, and each of them are $1,000 a piece. So I'm going to take $4 million of bonds, divide it by $1,000 for each of these bond debentures, and we arrive at 4,000 bonds. Let's see, and they can be converted into 8 shares of stock. And the common stock par is $100. But they have to wait till December 31st, 2026. So they buy them on January 1st, 2025. So it's 2 full years, all the way through 2025, all the way through 2026. So therefore, they can do it as of January 1, 2027. And it looks like some of them did. On 1/1/2027, 400,000 of bonds are converted. Let's see, market price equals 110. And then another 400,000 on March 31st. And here the market is 115. Okay, so we've taken our notes, straight line, and we're going to accrue interest at March 31st. Okay, so there's our notes. Let's scroll down our problem here and see what we need to do. So we have 4 requirements here. We're going to make the journal entries as of December 31st, 2026, January 1st, 2027, March 31st, 2027, and then June 30th, 2027. Let's begin. Okay, so we are now at 12/31/2026, and we're asked for the journal entries. So at this date, nobody's converted, so we're just going to record the December 31st interest payments, and we'll record any amortization of the bond premium at that time as well. Well, let's figure out, well, what is the bond premium? We haven't calculated that yet. Let's add some rows here and figure out the bond premium. So the date that they were issued, the bonds were $4 million bonds, and they were issued at 102. So the cash that came in, the cash that would have been collected is $4,080,000. However, we will subtract the amount of the bond from that, and we're left with the premium is $80,000. So that's the amount that we're going to have to amortize over 10 years. So we'll go ahead and divide that by 20 interest payments. Means that we're going to amortize every 6 months $4,000. So it's $8,000 per year over a 10-year term. But remember, we're doing it semi-annually at December 31st and June 30th. So twice a year means there's 20 interest installments. And therefore, we'll amortize the premium $4,000 every 6 months. Let's prepare our journal entry. So we're going to debit interest expense as always. We don't know what that number is yet, so let's continue with what we do know. And the first one is to amortize the premium on the bond. And we know that that's going to be $4,000. So when we originally set it up, it would have been a credit to premium on bonds payable. So as we amortize it, we will debit it every 6 months for the $4,000 straight line amortization. And then we'll credit cash. We have a $4 million bond. So there's our principal times our rate. Let's check back out our rate. Our rate is 8%. Times our 8%. So that's P times R. Now we need to multiply by T, time. And how much time? It's 6 month installments. So that's 1/2 of a year. So I'm going to multiply it by 1/2. And I'm left with $160,000 interest installment. So therefore, our interest expense is the difference, $156,000. So I would record that journal entry, or not me necessarily, Gottlieb will record that journal entry every 6 months. So it recorded it on June 30th, 2025, December 31st, 2025, June 30th, 2026, and again on December 31st, 2026. It would have continued to do that, this journal entry, for the next 8 years, except some of the bonds are converted. So we've got December 31st journal entry. Now let's move to January 1, 2027. And at this date, if we look back to it, this is when 400,000 of the debentures were converted over into common stock. The market value was 110, and we know that each bond can receive 8 shares of common stock. All right. We're told there's $400,000 of bonds that are going to be converted over. Let me add some formatting here. Bear with me. Okay. We've got $400,000 of bonds that are being converted. And we also have to take off the appropriate proportion of the premium that has not been amortized. So what we're going to do, let's do this. I'm going to scroll down a little bit, and we're going to set up a T account for the premium. Let's just do it right here. So the premium on bonds payable. And we're going to create a T account. And we're going to follow what is happening inside of this T account. All right, so the date the bonds were originally sold on January 1st, 2025, we look back up here and we see that the bond premium was $80,000. That's going to be a credit. And so let's put that into our account here as an $80,000 credit. And now let's amortize it for 2025 amortization. So that's over 10 years. We're going to amortize that, and it's going to be a credit. So let's move it over. I'm sorry, a debit. Let's move it to the debit column, and we're going to amortize it over 10 years. Remember, we're doing it twice a year, but in total, June 30th was 4,000. First was 4,000. 2025 is $8,000 of amortization, and we'll do the same thing for 2026. It's the same amortization, and the journal entry we just recorded it December 31st, 2026, was the 6 months, $4,000 for the second 6 months of 2026. So we stop right here and we want to know, well, what is our balance now? We started with 800,000. We've amortized 8 and 8. So we're now at 64,000. So this amount represents the balance at December 31st, 2026 is 64,000. With the bonds that were converted on January 1st, 2027, the problem told us there was 400,000 of bonds that were converted. So let's do a calculation here. $400,000 total bonds, 4 million. So the percent converted, $400,000 divided by the total 4 million of bonds that are there means that 10% of the bonds are being converted. Now, I need to know that because I'm going to take 10% of this balance and I'm going to have to immediately amortize that as part of the conversion. Or rather, I'm going to convert it into common stock. So let's go back to our problem here. So we know that the normal balance of a premium on bonds payables, we see right here, it's a credit. So I'm going to debit it. So we go back to my journal entry for January 1, 2027, and I'm going to debit premium on bonds payable. I don't have that amount quite yet. I do know that the debit to bonds payable is the 10%, 400,000, given to us in the problem as 400,000. And then I need to find the amount of the premium that is attached to that. And we said that it was 10% that is being converted. So 10% of this 64,000, 10% times 64,000 is 6,400. So 10% of the remaining balance of the premium on bonds payable is going to be included in the conversion, $6,400. Next, I'm going to issue the shares of stock. So I'll credit the common stock par account. I need to know, well, how many are being issued? So if we look back to the facts of our problem, we know that there were 4,000 bonds and they're each worth $1,000. Not worth, but that's what the face value of each bond was stated in the problem was $1,000. So if there's $400,000 of bonds converted, then we know there's 400 of them. So there's 400 bonds that are converted, and each bond at conversion receives 8 shares of common stock. So there's going to be 3,200 shares issued, which is the 400 bonds that are converted at $1,000 a piece for the 400,000, and each of those bonds are exchangeable, convertible into 8 shares of common stock. And now I need to multiply it by my par value. And my par value, common stock par, is $100. So I have 400 bonds converted into 8 shares of common stock with a par value of $100. And that leaves me with $320,000 as my credit to common stock. I don't have a balanced journal entry yet, so we also need to credit any additional capital. So additional paid in capital or capital paid in excess of par. My debits, we're converting $406,400 of bonds, and I'm allocating that between common stock par and capital paid in excess of par. And the residual of my debits minus the 320,000 for par means that the additional paid-in capital is $86,400. That is my journal entry for January 1st, 2027. Next, let's move to March 31st, 2027. So on this date, we have some additional conversions, but we also have to accrue interest through that part. As it says in the problem, accrued interest at March 31st will be paid on the next interest installment date, which is going to be June 30th. So let's take a look at our journal entries for March 31st, 2027. First, let's calculate the interest that needs to be accrued. So we'll debit interest expense. We will debit the premium on bonds payable. And then instead of crediting cash, I'm going to credit interest payable because it's not due yet, but I will have to pay that under the terms of the bond. I'll have to pay this interest since the bondholders held the bond, the debenture, through March 31st. They're going to get the interest for that from January 1 through March 31st. However, it's not paid until June 30th, but I still need to accrue the interest. All right, let's see. So how much bonds were outstanding? We want to be able to calculate the interest payable. So for these particular bonds, it says March 31st, 400,000 of the debentures are converted. All right, so my principal for these particular bonds that are converted, the rest of them are going to be paid as normal on June 30th. So I'm not worried about those. I'm only worried about the ones that are being converted at March 31st. Those that were converted at January 1st get zero interest. They did not hold it at all in 2027. Instead, they converted to common stock. But those that converted at March 31st do get some interest from January, February, and March. And those bonds are 400,000 face value. We know that our interest rate is 8%. So there's my P times my R, and my time is 3/12 of a year, January, February, March. So those 3 months out of the 12. So I'll multiply that by 3/12 of the year. And therefore I owe them $8,000 of interest. Now I also need to calculate what's the interest expense and the premium. So if we reflect back up here, we know that the total amount of premium that was amortized is $4,000. That was under a normal circumstance. However, at this point, we're only looking at 10% of the bonds for 1/2 of a year. So if we take 10% of the normal to get to just these 400,000, we would get $4,000 times 10% would be $400. But again, it's twice a year. And so it'd be not twice a year, it's half of the time. So let's see if I'm going to show you the calculation here. So let's just go down here. This is the balance. So our balance of the premium on bonds payable is $64,000 at the beginning of the year. This represents 10%. So that $64,000 was tied to $4 million of bonds, but we are only talking about $400,000 at March 31st. So that's 10% of the total. So that will give me my P. Let's see, and how many years are left? 8 years. So we will amortize that over 8 years because we're already 2 years in. And this is only half of a year and only half of that period. So if we think about the $64,000, I'm looking for 10% of it, which is $6,400, $6,400. And that's going to be amortized over 8 years, which is 16 6-month periods. Let me put that may be easier to see. 16 6-month periods. And it's only half of this 6-month period because it's January, February, March. And that leaves me with an amortization of my premium of $200. And as we did before, the difference is going to be interest expense of $7,800. So that's accrued the interest that is payable on the bonds. Now I need to convert those bonds. So let's reflect back on the journal entry we recorded earlier at January 1st. So at March 31st, bondholders have converted another $400,000 of bonds. Let's copy that same journal entry down because it's going to be the same format. We just need to find the amounts. All right, so let's go back and reflect back on January 1st. So $400,000 of bonds were converted. And at the time on January 1st, there was $6,400 remaining of premium on bonds payable related to these $400,000 of bonds. And then we converted those at January 1st over into common stock. Now we're 3 months later, and we've amortized a little bit more of that premium. So the premium on bonds is for this next group of 400,000 has been amortized a little bit more than those that were converted at January 1st, a little bit more by $200. So the amount of premium attached to these that still needs to be converted to common stock is $6,200. It's the difference. So there were $6,400 per every $400,000 of bonds, but 3 months have passed related to these $400,000 of bonds, which means they've amortized $200 worth. Common stock par, we know there are 4,000 bonds converted, just like before. $400,000, 1,000 apiece is 400 bonds converted into 8 shares apiece of $100 par common stock. So that's the same calculation we did above, and we found 320,000. And then the amount of additional paid in capital, just like we did before, is the net difference, 73,800. No, my math is not correct here. Check that math. There we go, 86,200. So the total debits of $406,200 minus $320,000 of credits leaves me with a credit paid in capital in excess of par of $86,200. Okay, that's March 31st, 2027. Now let's conclude with June 30th, 2027. So we're going to make our last interest installment. So as we've done before, we'll have a debit to interest expense. We'll have a debit to the premium on bonds payable. We also have some interest payable that's already been accrued. And then we're going to need to make a cash payment. Okay, let's work, as we always do, let's try the cash credit first. Okay, so how many bonds are still outstanding? Let's see, we started with 4 million, and then January 1, 2027, 400,000, 10%, was converted over to common stock. And then a few months ago on March 31st, 2027, another 10%, 400,000 were converted. So I have $4 million of bonds minus 400,000 that were converted, another 400,000 were converted. So that means I have $3.2 million of bonds that are still outstanding. Those were outstanding the entire 6 months. So they're going to get cash payments of 8%. And as before, it's for half a year. So that's $128,000. And that is the $3.2 million of bonds that remain outstanding for the entire 6 months, January, February, March, April, May, and June 2027. That's 3.2 million. Original 4 million minus 400,000 that were converted January 1st, minus 400 that were converted March 31st, means there's 3.2 million that are still outstanding, and they're going to get cash payments of 8% twice a year, and they're getting a cash payment of $128,000. However, we also have to make the payment for those that converted on March 31st, and we calculated that to be $8,000. So we owe them $8,000 for March 31st conversions, because they held those 400,000 of bonds that we recorded on March 31st were outstanding from January, February, March, and so they get their interest, and that interest is $8,000. So I'm going to add that to my $128,000, and now I have a credit to cash of $136,000. We know that the debit to interest payable is going to wipe that interest payable from March 31st to 0. So we will debit it by $8,000. And now I just need to calculate my amounts for amortization. Let's go back, and we want to amortize this premium on bonds payable. We need to figure out what that debit is. Let's see, where do we leave off on our T account? All right, so we're at March 31st, 2026. Well, we need to record the March 31st. So we're at December 31st, 2026. And we want to record the March 31st conversion. And if we go back to our journal entry, because we know at January 1st, we've already recorded. No, we have not. We need to record that as well. So let's back up and record a debit $6,400 to the premium on bonds payable. So on 1/1/2027, there was a conversion to common stock, and that was a debit of $6,400. And then on March 31st, let's go back and look at that journal entry. And we see there is also $6,400 of bond amortization related to the premium on bonds payable. We've got $200 here in the first journal entry and $6,200 in the second journal entry for March 31st. So both of those are $6,400. All right. So that handles the conversion. That handles the amortization for the bonds that were converted. Now we still have to handle the amortization of the bonds that remain. Let's see. So what is our balance at June 30th, 2027 before interest calculation? So we don't have our final June 30th balance because we're still working that journal entry. But I want to know what it is as of before we calculate the journal entry. Okay, it's $51,200. That's the amount of the premium that still needs to be amortized. All right, so let's go finish our journal entry here. So the amount of the premium for the remaining bonds, we know there's $3.2 million of bonds remaining. Actually, in a normal case, like we saw at March 31st, I'm going to try to explain this one more straightforward. We had $4 million of bonds that were amortized, bond premium that was amortized. Let's try that again. There's $4 million of bonds, and we amortized over 20 periods the premium of $80,000, we amortized $4,000 every 6 months. Now, some of these bonds have been converted. So what we have left is 3.2 million of bonds. Let me approach this from a different point. You have $4 million of bonds, and two $400,000 conversions leaves you with 3.2 million. So if we have 3.2 million left out of the original 4 million, that means we have 80% of our bonds still normal and outstanding as they were on the date they were issued. So 10% were converted on January 1st. Another 10% was converted on March 31st. That leaves us with 80% of our bonds still there. So our amortization is going to be 80% of what it was. Keep it simple. So what it was $4,000. 80% of that times 0.8 leaves us with $3,200. Said another way, we have 80,000 of premium. Let's calculate this. We have 80,000 of premium, total premium to be amortized. But we're only dealing with 80% of it because the other 20% are those two conversions of $400,000 worth of bonds. And we're amortizing it over 20 periods. It gives us the same $3,200. Let me stop and pause and I'll show you that formula. $80,000 of total premium we have to amortize. We're going to amortize, we only have 80% of it left. So I'm going to multiply that by 0.8. And I'm amortizing it over 20 periods, 10 years, twice a year, 20 periods. Gives me premium on bonds payable amortization of $3,200. Now that I can calculate my interest expense. I'll take my cash paid at 136. I'll subtract the amortization. I'll subtract what's already been accrued for interest payable. It means it was expensed prior. And let me fix some formatting so we can actually see it. And I'm left with a debit of $124,800 for interest expense. A lot of calculations here. Let's conclude the problem with an amortization here. What did we say? $3,200 to debit premium on bonds payable. And so the final adjusted balance at June 30th, 2027 is $48,000. That still must be amortized over the remaining 7.5 years for the 80%, 3.2 million of bonds that are still outstanding. At this point in the problem, we have worked parts A, B, C, and D, and we've followed the conversions using the book value method. And so with that, this concludes the demonstration to solve exercise 15.6, conversion of bonds.